So their business model is pretty straightforward. They're sitting in the middle, in the blue there. And on the left side, we have investors. Now, investors have capital and they want return. That's the nature of every investor. And they would then provide capital to a fund that is established by the VC. Let's call it Halt Venture Capital Fund number 1. That Venture Capital Fund number 1 will have a very specific document that shows how much money is going to be raised, what is the purpose of that investment fund, what are the terms of the investment in terms of how long will it exist, and how would money be distributed. So it's a legitimate investment vehicle in using the mechanism of a limited partnership. So now the venture capital has raised a pool of funds from its institutional investors. What do they do now? Now they look for deals. They look at various opportunities, and they have to be pretty selective because in order to meet the return expectations of the investors, they need big victories, not small, okay investments. They need large successes because the expected return is quite high. So what they will do is then negotiate agreements, usually through preferred stock agreements, as evidenced by a term sheet. And those will set out the agreement between the venture capital and that specific investment pool and the private enterprise, the actual ventures. When we look at rate of return for VC funds, first of all, it's highly volatile. So it's not some steady thing that looks like even a treasury bill or an S&P index fund. It is volatile. But within that volatility comes an expectation of high returns. Where does money come from? These are the people seeking high returns. Now, let's look at the names. They're public pension funds. They're endowments. Endowments are like money put into a university in order to sustain into the future their educational efforts. Other might be families that are wealthy. Other might be insurance companies. Now, those don't exactly sound like high risk takers, do they? They're retirement funds. You don't want to mess with that money. They're also educational monies. You don't want to have high risk there. So how does that work? That seemingly risk averse investors would end up putting money in VC funds. The reason it works is the core to every investment pool and investment manager is what's called allocation. And how do we allocate the investment amount among various classes of investments? So the core to most investment funds are in the securities. They're liquid, you can buy and sell them freely, they're easily analyzed, and you can design portfolios to meet a variety of objectives. But there's a little sliver of that larger fund that they may want to put into higher risk investments. And that is where VC lives. They're also often called alternative investment classes because they're not really the core to most investment portfolios. They're alternatives. And things like real estate allocations would be part of that. And also venture capital or private equity, they would fall in these kind of small slivers of an otherwise large investment amount. Now, when we look at the VC investments, this is some of the cyclicality, and this is the most dramatic thing that's happened, was what we call the internet bubble, which happened in the late 1990s and early 2000s. And it was when the internet was first born. And we thought that the markets will all open instead of having a small market geographically bound. The world was our market. And instead of having brick and mortar, we could do everything online. So e-commerce was the rage. And a lot of money chased these deals, which caused a larger run-up in the production of venture-ready companies and IPOs. And they're what we call premature births. They probably should not have gone public, but they did because of the insatiable appetite for these types of investments on the part of public investment companies and the public, the investing public. So finally, in 2000, 2001, the bubble burst. And when people realized we have made a mistake, that we invested in very premature companies that aren't really ready for institutional investment, and then the prices collapsed. So that was the internet bubble, and it burst. When we look at the venture capital firm, as mentioned a little bit before, let's look at more detail. So the first thing is the VC firm, which is a collection of experts in usually a narrow field that they will want to make investments that are very well thought through because they're industry experts. They will then create a document to evidence that they want to start a new fund. They will solicit people for these allocations of funds and try to convince them that they're worthy managers of investments for these large pools of money. Then to look at commitments from these companies. Notice that when, let's say, CalPERS, a large public employee retirement system in the state of California, when they allocate amounts, say $50 to $100 million, they don't write a check or wire the funds to the VC firm. They have commitments, and a commitment is firm and binding. So they say, I will transfer to you when requested this $100 million to support HALT VC fund number one. Then the company then will find investments and then conduct their due diligence to make sure those investments do warrant investment from their pool. Then at that point, they will then get the money from the institutional money, invest it, and then they'll start working with the company to develop the business, get it ready for a liquidity event, a harvesting event. And these are typically a merger and acquisition or an IPO. Once that's completed, then they give the money to their limiteds, because that was the nature of the relationship. The limited partners, institutional money, put money into the pools. The VCs manage it productively to generate a lot of profit. Then the investors get their profit. And then it starts all over again, because the VC firm says, you like what we did in fund number one? Why don't you invest some more in fund number two? And so they try to perpetuate a series or a whole set of successes in their different funds. And that's how the industry works for venture capital.